everybody. Today we're talking about California's pass-through entity tax, or PTE. What is it? What are the benefits? The things to consider. And then we'll take a look at an example of how using this can lower the overall amount of federal taxes you pay. Hello, Trips. Why are we talking about PTE today?
So PTEs come up quite a bit in conversations over the last couple of weeks as people close out 2022. They start thinking about filing their taxes for 2022 and then moving forward into what taxes look like for 2023. And the conversations I've had have really landed in two polar opposite categories. The first is people say, I love PTE. I'm so glad my CPA has helped me find this workaround. And the second is, I have no idea what you're talking about. And that really is what we wanted to record this video for, is that second group of people who may be missing out on a pretty valuable tax benefit.
Yeah, let's just tell people a little bit about what it is. So this is really born out of the Tax Cuts and Jobs Act, the TCJA of 2017. And one of the components of that act was that it severely limited the deductibility of state and local taxes, known as the SALT tax, on one's federal tax return to $10,000. Before, it was unlimited. And in super high tax states like California, New York, people are paying significantly more than $10,000 in state and federal, state level taxes, property taxes. So the Tax Cuts and Jobs Act limited that deduction on one's federal return to just $10,000. So these high tax states created a workaround. And the workaround is only for entities that are taxed as partnerships or S corps. And how it works is the entity pays a flat 9.3% tax rate of qualified net income, effectively the profit that would come down on one's K-1. And that is paid directly to the franchise tax board.
And when we say taxed as a partnership or an S corp, very common for people to have an LLC taxed as an S corp, and so we are talking about those entities as well.
And why this works is that 9.3% is now a deductible business expense at the entity level. It reduces the profit of the business for federal tax purposes. In addition, this will show up as a credit, a dollar for dollar credit on the partner's individual state tax return in their pro-rata share of ownership in the company. The craziest part about this is that it was approved by the IRS. So it was a law meant to reduce the deductibility of state income taxes by the federal government, but this workaround has been approved by the IRS.
Yeah, it's unfortunate we have to have a workaround, but it's nice that it's there.
Some things to consider. The entity must opt into this annually. It's not automatic, and it is binding for that entire year. The 9.3% entity tax is a non-refundable credit, but it can be carried forward on the personal return for up to 5 years. And it is only available for tax years 2021 through 2025.
Yeah, and the reason it ends in 2025 is that's when a lot of the provisions of the Tax Cuts and Jobs Act are set to expire or revert back to the prior laws. And so who knows what's going to happen in 2026? But we do know that at least for the next 3 tax years, this is in play right now.
Can't wait to go through that fight again in 2025.
Yeah.
One more thing to consider is that election must be made when the entity tax return is filed.
Now, one thing to point out on the payments is that second payment isn't due until your tax filing deadline, but your CPA will likely have you make it in the calendar year so that you get the deduction for the year you're working on, as opposed to pushing it to the next tax year.
Yeah, that's a really great point. And then just a word of caution before we get into a sample. This is not tax advice. Clearly talk to your tax professional whether this is right for you. And then we've got a link here to the Franchise Tax Board website, specifically to the description of the pass-through entity elective tax. So please reference that and contact your tax professional.
Yeah, perfect.
Want to get into an example?
Yeah, I do. So I put together a really basic example. Some of you have seen this software that we use for running scenario analysis on tax returns. What I did was I just took as basic of a business as I could. The owner's making $125,000 of W-2 and has $1 million K-1 for their S-Corp. And at the top of the screen, I put together 2 scenarios. The first is they are not taking advantage of the PTE tax. The second is they are taking advantage of the PTE tax. And where you see that borne out is when you look at the total income that's going to be reported on their federal tax return. See a pretty big difference there, because they have paid 9.3% of that $1 million on the entity return, which means that they have less flowing through to their personal return. And really the reason why we're doing all of this is when we get to the bottom line, which is looking at the taxes that you would be paying on your federal return. $369,000 versus $331,000. $38,000 less of taxes that you would be paying to the federal government as a result of going through this process.
Yep, it can be really worth it. Again, if it's right for your situation, certainly reach out to Ryan or I if we can answer any questions or be part of that conversation with you and your CPA. Until next time, thanks.
Thanks.